Welcome to Your Money with Leo Daprile. I'm Leo Daprile, and each week on AM 570, Dan Rivers and I will talk about anything and everything to do with your money. If you ever have questions, please feel free to call me at 330-533-6936, or you can email me at leo@gemyoung.com. Enjoy the show.
This episode of Your Money with Leo Daprile is sponsored by Grange Insurance.
Time now for Your Money, brought to you by Gem Young Wealth Advisors. Leo Daprile has joined us. Good morning, Leo. How are you, sir?
Good morning, Dan. How are you today?
Oh, nice to talk to you. I'm hoping for a Penguin win last week. I know you and I are both fans, and we got close, but maybe this week we take on the South Dakota. They're supposed to be the best in the nation. It doesn't get easy.
I got to tell you, Dan, I never get tired of hearing Bob Hannon's analysis of the team. He's always spot on. He's got the depth, the knowledge, and he's got a real feel for it.
Yeah, he really does. It's kind of like you working in money. I was just looking here, and we had a little sell-off on NASDAQ yesterday, but it looks like everything's recovering nicely today, isn't it?
Well, that's one of the things I wanted to talk to you about today. Yeah, we are having a bounce today. There's no question about it, but we actually fell into correction territory yesterday with the NASDAQ, meaning it's down. The definition of a correction is down more than 10%. From its high, and that's where they finished yesterday, even though it's bouncing currently up about 2.5%, which is going to erase what it lost yesterday. But the bigger picture is how are a lot of these tech stocks doing year to date? Because that was all the talk last year. We've talked about that plenty of times on the show about how the top FANG stocks have been driving the market. Well, they're kind of driving things the other way right now. And we've talked about a couple of weeks ago that this is actually a more challenging year for money managers because the passive strategy which so many people deploy to managing their money is really not working this year. It's actually working against them. The better managers were taking these signs towards the end of the year and saying that a lot of these growth stocks went so hot. And there's reasons they got as hot as they did, and there's a reason they're pulling back down because as it's looking more apparent that maybe the country is going to open up a lot sooner than people thought, like maybe by May, if there's the opportunity for vaccines by May, then there's a lot of other companies that have the opportunity to begin to prosper again, which is a key point. But the bigger picture to that point is a lot of these tech companies that were really driving growth last year, the reason their stocks are starting to take the hits that they are has more to do with people are starting to say, well, maybe I'm going to go back to the mall. Maybe I'm not going to just buy on Amazon. So they're looking for a lot of these companies that had accelerated growth because of the pandemic begin to cool.
Oh, okay. Well, that would make sense, right? As people go back out, they have other options, and even the tech stocks won't be doing terrible, but they're not going away. But you're going to have other competitors now, and that they really haven't had during the. That makes a lot of sense, Leo.
Yeah, and it's like anything, Dan. They're going to have to earn the valuation. So here, I'm not going to throw a lot of numbers at you, but I want to give you a couple of numbers just to give you perspective and point out that a lot of the conversations I had with the key money managers that we work with had made the portfolio shifts back in November and December because they kind of saw this coming. So this is not surprising us, but let me give you just some year-to-date numbers. The Dow Jones Industrial Average, which is one of the most widely followed indexes, is up 3.91% for the year. The NASDAQ before yesterday is down 7.2% for the year. There's also another index called the NASDAQ 100, which is the 100 biggest companies in the NASDAQ. That's down 7% for the year. And if you look at the NASDAQ 100, and it's a weighted index, which means the bigger you are, the more influence you have over the index, Apple represents 11% of that index. So you have
really driven by
companies
Apple.
last year that were companies last year that were darlings, like Tesla, is off 20% for the year. So although this was a fun ride for people last year, this is why being prudent and knowing what to own and knowing when to sell it and knowing where your sectors are going to move is so important.
You mentioned Tesla. Why are they off, in your thoughts?
I think it was just run up. I think there's just too much euphoria around Tesla. I look at Ford year to date, and I don't have the exact numbers, but Ford Ford started the year around 8, they're 12 and some change. So Ford's up 30-some% for the year, because you're starting to see that Ford maybe is not that old stodgy company. They're coming out with the Mustang Mach-E. They have a hybrid pickup truck now. So people are starting to see that Tesla is not the only electric car maker. General Motors has a host of cars that are electrified due out shortly. So I think people are starting to realize in the EV market, there's in the next year or two going to be significant competition to Tesla.
Yeah. Well, I'll tell you what, just a little bit off the mark here, but I was reading today where they are very concerned about the waste that these big wind turbines are creating. I didn't know this, but those big fins that they have on there, those things are made out of fiberglass, and about the only thing they can do is cut those up and put them in the landfill. And these things are starting to clog up the landfills. If you can imagine how long they are, they're cutting them up, putting them on flatbed trucks, and they're probably going to be around forever. So, on one hand, you think, well, we want renewable energy, but on the other hand, those things are big polluters if you think about contaminating our earth. So I'm not sure that we've got this right here with the electrical vehicles, and with we're going to have problems with battery disposal too, I would imagine.
Yeah, I'm from the camp that likes to drive. I think the closest I'm going to get to an electric vehicle would be a hybrid, because I'm not going to drive for 250 miles and then sit for an hour for my car to charge. So from a practical point of view, that's just not a fit for me.
Yeah, I mean, you're a guy that nothing more that you enjoy is getting in the car and driving to Florida. You love to drive and watching. I'm kind of the same guy, but you're right. Even if you get the quick charger, you're coming down here. Every tank of gas is going to at least take 20 minutes, but I think it's longer than that, because you may have to wait in line. You may have to get hooked up. I just don't know if it's going to be that fantastic unless they get it down to science.
It makes sense if you live in a big city and you don't drive a lot. But then again, Dan, to the point you brought up before, that you need fossil fuels to make the electricity to have a clean burning car.
Yeah.
So you didn't really solve that problem over time. You still need that front end fossil fuel to get there.
Yeah. Hey, back to the financial stuff here. What's with the bond market right now? 6 weeks now that they have pulled back, right?
Yeah, it's beginning to sell off. And again, that's optimism driven. When you see a lack of interest in bonds, it's because there became an interest in something else. Okay, when people pile into bonds, they're concerned about market correction, so they're running for safety. Okay, and when they're running for safety, yields go down because prices go up. There's always that inverse relationship between the two. So now they're looking at it saying, especially in the last month, Dan, and that's why it's coinciding with the bond market, with all of a sudden there's going to be ample vaccines sooner rather than later. We're not talking about being closed up till September, maybe May, maybe June. So there's 3 months back of economic activity back in the conversation that wasn't there maybe 3-4 weeks ago. So people are starting to look and say, okay, this year my opportunity for growth is going to be more in stocks, and I don't have to have the safety of bonds because this isn't as dire as it was a month ago. So that's, to me, that's the reason why you're seeing that change in the bond market.
Yeah. So what do you see here? I got a call, or somebody wrote to me and they said, hey, we heard on your radio station that somebody was paying 3.5% for a savings account. And I said, that's highly unlikely because most of them are under 1% now. But to that question, it generated another. Is there any place where you can put your money and still be semi-liquid? People that have maybe some money in the bank that's drawing nothing right now?
Yeah, that's a tough one. With interest rates staying low, it's always to the detriment of the saver, the benefit of the borrower. And that situation is going to stay that way for some time. So if somebody's getting a 3.5% yield on an investment, Dan, that's got to be some kind of bond. I can't imagine anything guaranteed paying you 3.5%. Sounds like maybe it might be an annuity potentially. And if it's an annuity potentially, then I would say that might fall into the index annuity category where they're trying to build up more returns, because I just know with the insurance companies that I deal with, you see what the yield is on their investment portfolio, that they can't put your money into a regular investment, invest your money, and still pay you 3.5% back. That environment. That sort of
now that you mention that, now that you mention that, I maybe I did see that online. I don't remember it being a commercial on our station, but I believe I think I saw something where there was some annuities out there that were 3.5%, and that would make sense. And of course, with annuities, there's a big contract there, and you have to know what you're doing. Usually there's a lot of money up front goes to the broker. But we've been down that road before. But, the bottom line is if people have, money sitting around in certificates of deposit, or if you have them in a passbook savings account, the only way you're going to get any kind of a yield on that is to take a little bit of a chance, right? You've got to invest them in some kind of a stock portfolio.
The whole strategy, Dan, and what I like to tell people, maybe this is the way I was brought up. It's all about risk management. Because nothing in your world is without risk, and sometimes when we have that big fear about having no risk in our money, we actually just have different risks by not having the risk of loss. We have risk because of the lack of growth, because of we're underperforming inflation, so we have the loss of our purchasing power. So, it's better to say let's take intelligent risk. Let's take a risk built around what you feel, not how I feel or what I think you should do. And you know me well enough, Dan. I'm going to give you guidance. I'm going to give you suggestions. But at the end of the day, I'm going to say, you tell me what's best for you. My job is to give you as much information as I can for you to make as an informed decision as you can. But then you tell me what's best for you. That's how you have to look at it. So you just can't stay myopic and say, I can't take any risk, because in today's world, you're not going to keep up with inflation with that way of thinking.
Does the old axiom still hold, Leo, where you might take money and put it into a utility stock because, we always need electricity and we always need natural gas?
Yes, but we've broadened that category of just utilities. We've looked at it, and that's a good way to look at it. It's part of one of the things I wanted to talk about. We've talked in the past the difference between growth stocks and value stocks, and last year, growth stocks. And just a quick reminder, a growth stock is you buy a stock saying they got a great product, they're going to do really well, I'm going to buy it at 20 because I think it's going to 40, for instance. A value stock is, hey, they're priced at $20 today, but when they get to $18, that's the real price, and I'll buy it. Well, last year, if you had a growth tilt to your way of thinking, you did extremely well, and value didn't. But this year, the reverse is happening. So I point that out because a lot of the utilities you fall into the value category. So they didn't have a great year in terms of pricing, although many had a great year in terms of profitability. That's what the managers have been opening their eyes to by saying there's a lot of opportunity in these value stocks this year. And that's one of the reasons you're seeing things like the Dow Jones Industrial Average have such a big swing as opposed to the NASDAQ, because the NASDAQ is typically growth-oriented stocks that have run too far, and that everybody's starting to come back to earth on them and saying, okay, maybe we pushed this too far. And part of that, Dan, is now that we have more individual investors in the market, they're driving things higher than they should.
Give me an example of a growth and a value.
A growth stock would be Apple, Amazon.
Okay.
Those are growth stocks. They're not really worrying about profitability. You take a value stock, somebody like a Johnson & Johnson. Here's the best way I can put it. If you use Tide to wash your clothes, right, whether the market's up 30% or down 30%, is it going to change your opinion on whether or not you buy Tide? You know, when you need detergent and you've been using Tide for 30 years, you're just going to go buy more Tide. So if you think that way, why wouldn't you consider owning stocks? Because don't you think most people think like you? Mm-hmm.
Is that something that you can help people with? Yeah, I mean, absolutely. Because you're saying, you know what, I shop at Target, so I'm going to go to Target, and I think they're going to do well because we go there a lot. Or I'm going to go to Sam's Club. I got it. And then, of course, your value stock is something that you think is going to always be around, such as a Dominion East Ohio or First Energy.
Right. And value stocks typically don't get a lot of conversation, Dan, because they're typically not the sexy stocks. They don't have the flashiest new product, but they're there every day. They're products you use every day, things you don't even think of that you use every day.
All right.
But they're there, and they're going to turn out their income.
I've got one more question for you, but give folks a little bit of an indication of what you do. I'm aware of it, but maybe others are not. Please go ahead.
Sure. We're a family business, does business with individuals and families that need comprehensive risk management for their wealth and their assets. Specifically in the wealth management sector, we've built processes and procedures to help those folks aspire to a work optional lifestyle, and we continue to hone our processes to just make that even better and more accurate for people. It's a lot of fun. We start with a fit meeting. Our clients, we get to know very well. Our clients over time, many become our friends because we care that deeply for their success and to have the positive outcome that they're trying to get to.
Fantastic. And Leo Daprile, you can find him at Gem Young Wealth Managers. They're in Canfield. I'll give you the phone number here in a second and how you can reach Leo directly. And he's glad to take your phone call. Then I have one more question for you. Leo, if you will, with your information, I always say search Gem Young and you're going to get the phone number if you forget. But we'll give it to you specifically. Go ahead.
Sure. You can call me at 330-533-6936, or you can email me at leo@gemyoung.com.
All right, so you want to give me an insight into your business here. I don't know if you're going to make me a partner or not, but tomorrow you and I are going to have a meeting tomorrow. Should I be studying? What are you going to teach me generally tomorrow?
Well, what I really want to do, Dan, is we've talked a lot of what we've done and what we put together for you, the portfolio we put together, but you've never really had the opportunity to talk to the people that I talk to on how the theory and thinking behind why we built what we built for you. So I want to give you that opportunity to go to another level to talk to people most of my clients in the past haven't had the opportunity to do. And they're going to actually go over their specific portfolio, review your specific portfolio, not generalities, and tell you why we do what we do and why we make the decisions we make and how we get to helping you get to your goals as a result of all of that.
Well, I'm going to school tomorrow afternoon at 3 with Leo, so we'll look forward to talking to you at that time, and I'll see the insight on what they have done for me, and I can tell you all about it the next week. But Leo Daprile, a friend and also a man that cares a lot about your success. If you're looking to have someone watch over your portfolio, he's a guy that will take it on as a vocation, and he's like a priest. But in any case, Leo, one time for your phone number here.
Sure, 330-533-6936.
All right.
Or you can email me at
leo@gemyoung.com. leo@gemyoung.com. All right, I will see you tomorrow afternoon, and appreciate the invite. I'll look and see how the sausage is made, right?
You got it. And all you need to bring tomorrow, Dan, is a nice cup of coffee.
All right, very good. I can handle that. Thanks so much, Leo. You have yourself a great day.
You got it. You too, Dan.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.